welcome to CCI Educational Seminar. I am your host. My name is Dampa Solomon. Here is our speakers for today, Mr. Yusuf Jamai and Mr. Respect Sunday. So this is our speakers for today. So what we are having now is introduction to Forex and technical analysis. After this training, we'll be having certificate of participation, certificate of training that will be sent to you via email by the CCI group. About Mr. Yusuf, I'll give you guys a brief about Mr. Yusuf. Yusuf Jamai is a professional trader, Forex trader, and he trades order flow and exact market turning points using price action and market algorithmic movements. With strict adherence to risk management, yet incredible risk to reward ratio. Incredible risk to reward ratio, and he has been consistently profitable in the Forex trading business. In Jamai's words, he said, making 100% of your account with minimum risk per trade and optimal profit should be every Forex trader's goal. This is what he teaches his students to achieve consistently. With the right knowledge and effective risk management, you will realize that Forex trading presents the best and most secure business opportunities in the world. Ladies and gentlemen, meet Mr. Yusuf, a price action and market algorithmic trader. Mr. Yusuf, over to you, sir.
All right, thank you very much. My name is Yusuf Jamil, and I am going to be your trainer, your first trainer for today, Forex 101. I'm taking you through what Forex is and technical analysis, more like, introducing you to the basics of Forex trading. I want to believe that most of us who are joining this training now are more likely going to be new to Forex trading. And for that reason, we're going to be introducing you to what Forex trading is and why Forex trading is an essential part of living, actually, because in the world we live today, it's all about economic meltdown, business going down. We're really having a downtime in the world entirely. People are losing their jobs, salaries are getting cut off, people are being laid off, and a lot of things are happening. Price hikes in various commodities and goods and services. We have the petrol price going up. We have what's the name again? We have the electricity bill price going up too. So a lot of things are happening in the market today. And these are some of the reasons why you begin to wonder that, okay, if these things are happening, why is it still that people are making money on the internet? Okay, so you see, now is the time where anything that has to do with internet business is being favored mostly. Okay, because if you check it out very closely, you're going to realize that one of the necessary ingredients for you to excel on the internet is data. So that is more like the price you need to pay. Aside from data, then time. Unlike when you have a business running around you and you need to build a physical space, you need to put a whole lot of energy into it. You need to be careful, security and all. Okay. Now, for us to leverage on the internet of time, we are choosing Forex trading. And why Forex trading? Because Forex trading is actually the one skill where the customer is already waiting for you. The business is already there. You don't need to learn a skill and begin to look for customers to come buy what you're selling, because the Forex market itself is already a customer to you. All that is required of you is to learn skill, then go into the market and then trade. Okay, so learning that skill is very crucial to your trading career, and that's what we intend to teach you, and we're also going to teach you at CCI Trading. Okay, so today we're going to look at the basics of Forex. It's very important for you to understand that we can't really finish this topic today, because of course, just like you went through the university to study some courses for like 4 years, 5 years, 3 years and the likes, just for you to earn a living after that. So 4 years is a long time, for you to master such. So don't think you are going to master Forex trading within an hour or two, okay, or even within a week or a month. All right, it takes time. However, while you are busy learning, CCI has actually put in place some tools for you to earn at the same time. So that is what really makes it fun. Okay, now going into forex trading. All right, I tell people forex trading is actually one of the safest business in the world, as much as it is risky, because we have disclaimers left, right, center. However, it's still one of the safest business in the world because it has to do with risk to reward ratios. Okay, this and more are the things you're going to understand as we proceed in our education. It's not something we're going to be talking about now. But one thing I want you to know is, if you're on this call today, you're listening to me today, be rest assured that if you follow the rules, you learn the education, you are actually getting into one of the safest business in the world, for real, because this is the only business that I have come across in the world that you actually have control over your risk. Okay, you have control over your risk, and whatever it is that you can control your risk on, then that is most likely going to be safe for you, because virtually everything in this life is risky. Waking up is risky, stepping out of your door is risky, eating is risky. So when you have a thing that you can actually control the risk on, then that is most likely going to be the go-to place. All right, so now let's quickly go into forex trading, and more importantly, why forex trading. Okay, like I just still talking about why forex trading is one of the safest business too. Like, I tell people this: if all the business in the world come down crashing today, forex trading won't. And the reason why forex wouldn't is because for all the business in the world most likely to excel or to do fine, it's most likely going to be depending on forex trading. Okay, you ask me how. All right, now if you understand what is really happening in the world in terms of the business organization, that the businesses that we are doing left, right, center, and all, you're going to see that we have international trade. Okay, which is compulsory. When in as much as there's international trade, then there has to be forex, in the sense that no country is actually independent. Okay, every country is dependent on one another, because the natural resources across the globe is actually shared between countries. All right, so when one country needs cocoa, the other country doesn't have. When one country needs rubber, the other country doesn't have. So this calls for what? Exchange of natural resources. And for this to happen, then of course you don't just go there and say give me, and then you expect them to give it to you. No, it doesn't happen that way. Okay, you're going there to exchange something for something, and that takes us to some of to the point where we'll talk about the history of forex. Okay, so the forex, as much as you have the history of money, but those of us that actually studied it in school, as much as we have the history of money, we also have the history of forex. And the history of forex, goes back to the past, to the barter system, where goods are being exchanged for goods too. Okay, until the the late 1930s, when the Chinese actually introduced the paper money. All right, so now, for just like the name implies, forex, okay, it just simply refers to as foreign exchange, and for short, most people call it what? FX. Okay. You say I trade FX. I trade forex. Most people don't really say I trade foreign exchange. Yeah, because it's kind of long. So it's always about I trade forex or FX. I'm into the FX business, FX exchange, and the likes. Okay. So forex. What is forex trading? Forex, which is also known as FX or currency trading, alludes to a decentralized global market where all the world currencies are traded. All right. So this is the most important thing. Like, it is a decentralized global market where all the world currencies are traded, and this gives you an insight into what is actually being traded in the forex market. Okay, so forex simply implies foreign exchange. It alludes to a decentralized global market where all world currencies are being traded. Forex trading can also be referred to as a global over-the-counter (OTC) market where institutions, traders, banks, and investors speculate, exchange, buy, as well sell world currencies. Usually forex trading involves buyers and sellers who transfers currency an agreed price. Okay, so a lot of people wonder now, okay, you said you're trading forex. Yeah, if you're not trading forex over the counter, that is like we do, or let me just put it as, if you're not trading forex on the internet like we do, forget it. You're trading forex one way or the other. In as much as you are buying and selling, you're already trading forex. there is hardly anyone today that is not into buying and selling. At least at some point you must have bought something. All right. So in as much as you bought, all right, and most especially you bought how do I call it, an international transaction. Yeah, like you go on the internet, let's say Jumia.com, and you pay for an item with your card, or you go, let's not even use Jumia, let's say Amazon.com. That makes it a whole lot easier to explain. Amazon.com or any of these international websites, yeah, or you want to pay for your flight booking, okay, abroad, you want to import an item. These days we have the mini importation being rampant here and there, so people can actually buy things in little chunk and send it down to the country, like Nigeria, for example. And once, in as much as these transactions are taking place, card transactions and the likes, you're already getting yourself involved in the forex market, because when you pay for a transaction, a dollar transaction, for example, with your Naira card, all right, remember, it's not dollar that will be removed from your account. It is the equivalent in Naira. And at every point in time, we have this currency rates changing. And as much as there is buying and selling, okay, the forex market is still going to be there. All right. So now let me quickly take you guys through how the forex market actually came to be. Okay, now let's talk about what is traded in forex, then a little bit about history of forex. Okay, a little bit about history of forex. Yeah. Now, what is traded in forex, you already know. We talked about it earlier. We said it is currencies. So every country has its own currency, our home currency actually. Every country has our own currency, like the Nigerian naira, the US dollar, the Australian dollar, the New Zealand dollar, the Japanese yen for the Japanese yen for the Japanese. We have the Swiss franc. Okay, we have the Swiss franc. Let me see which again. We have the Mexican peso. Okay, we have the South African rand, and so on and so forth. So you see, every country has his or her own currency, and these currencies are actually what is being traded in the forex market. Because, like I said, in as much as you're making a purchase of an item, then you are going to need to pay for it. And when you're paying for this item, you're going to be paying for it with your own currency, however, at the rate of the other currency, because you don't have that other currency. So it's going to be exchanged. Okay, I hope that is really, really clear, because I'm really trying to emphasize on that, so you know what is really happening in the forex market. Okay, I'm not even talking about forex trading now. Okay, I'm talking about the forex market generally, like what is really happening. It's all about that exchange, the import and export, and the whole thing, and the currency change, switching from one currency to the other, and all that is the whole thing that has to do with forex. So you see, this is actually a necessary route to livelihood, and that is why we keep saying that this is an essential part of life. Everybody should be involved. Everybody is already involved in it. Okay, that's the truth. So when we say everybody should be involved in it, we're more like saying it formally. Let everybody be involved in it. All right, because it's actually worth it, and you get to understand why as we continue. All right, so what is traded in forex market? Like I said, there are all these currency pairs: the New Zealand dollar, the Nigerian naira, the South African rand, and so on and so forth. Yeah. So now, aside from that, I want to talk about the history of forex. Okay, so you can quickly grasp why we are trading currencies now. Okay, so before now, the human world, it's an evolution. We are actually growing over time. Okay, all right. So before now, like I explained earlier, we had the barter system where goods were being exchanged for goods. So such that then we can easily say that the forex market had to do with goods being exchanged for goods. Okay, however, now it is currencies that are being exchanged for what? For currencies. Okay, and we still have gold too. All right, so that is foreign exchange for you. Okay, so barter system, then goods being exchanged for goods, then everything grew. We had paper money, we had we had gold, we had gold, then we have precious materials, precious metals, that's gold, which is part of them. So I don't just want to say gold so alone, so you don't think it's just gold. We have silver and the like, so precious metals. Then we have currency pairs now, which are the money that you have left, right, and center. And with this evolution, everything was not thrown out. Okay, everything was not thrown out. It's not like, okay, so since the barter system was there, those goods that were being exchanged for goods are gone. No, gold is gone, precious metals, they are gone. No, now it's just currencies we are going to focus on. No, it is not like that. Okay, everything is still there in the forex market. It's just that the currencies are actually gaining more attention than every other materials or item that is traded in the forex market. Okay, so in the forex, when we now come to forex trading, okay, before we proceed to the other part of this broker and everything, but we now come to forex trading. Okay, then that's when we're talking about trading these currency pairs. Okay, these are the things, trading these currencies. Okay, that is when we talk about forex trading. We're talking about forex, which is foreign exchange, and we talked about currencies, which is what is being transacted in the forex market. And now we'll talk about forex trading. Okay, before now, forex trading was not available to you and I. Okay, before now, forex trading was not available to you and I. And the reason is that you need a huge amount of money for you to trade forex. You need a huge amount of money for you to trade forex. So it was not available for you and I. And another reason was that it was not even available on the internet. It was mostly paperwork. Okay, if you're familiar with the Nigerian terms, there's something called Baba Ijebu, where you have one big long sheet like that, and you begin to read. Okay, this is it. Okay, so it was more of that in those days. Okay, it was more of that in those days. So it was one big sheet like that you begin to read the market from. So it was really tedious, and you need an humongous amount of money for you to trade it. So we don't have such money. You and I, we don't have such money. You know, when I say such money, I'm talking about an average of 500 million US dollars. Where do you want to get that from? Okay, so that is why in those days the people will have that are trading the forex market, and this brings us into market participants. Okay, we talked about what is forex, we talked about what is traded in forex, we talked about history of forex, you know, just giving you an insight into everything. Now let's quickly look at market participants. Okay, who are those that are participating in the forex market? Okay, so we have the government, we have the central banks, we have the commercial banks, we have the hedge funders, we have the retail traders. Okay, so let's limit it to these five. Okay, now, before now, you know, I was saying the forex market was not available on the internet for us to trade. Okay, and I said you and I. So amongst these five market participants that I have listed now, where do we fall into? Okay, where do we fall into? You and I, where do we fall into? We actually fall into the retail traders. Okay, we are the retail traders. Okay, amongst the market participants. Okay, now oftentimes, so when the internet was introduced, you can actually trade with as low as $10. Imagine 500 million, now $10. Okay, so with the advent of internet of time, and now we can actually trade, the market has been brought on the internet, so we can trade the market via our computers now or our mobile devices. So that makes it a whole lot easier, and the retail traders were introduced, and since then we've been really trying as much as we can, you know, to get into this market and get the best out of it. Okay, you know, but the thing there is, most retail traders, we're greedy and we just want to get into the market and take all the money out of it. No, it doesn't work that way. Okay, it doesn't really work that way. You need to have the right education for you to trade the market. That is why majority of the reason why retail traders fail in the forex market is because they don't have the patience to actually go for the right education and understand it perfectly for them before they go into trading, and that is what CCI Traders is actually providing to you guys going forward. Okay, right from time going forward too. And now that we now have the retail traders in the market, we can trade with as low as $10, $100, $1,000, $100,000, whatever you could actually your capacity could actually carry. Okay, now aside from that, what about the other market participants? What do they do in the market? They just trade. Okay, you oftentimes you hear that, okay, the central bank put so amount of money in the forex market. Do you think they are trading the forex market? Okay, so when we talk about market participants, what we are simply saying is everybody has a way they participate in the market. Okay, retail traders actually participate by trading. Okay, amongst all the market participants, okay, the one out of them that does not participate by trading, rather they participate by stabilizing, is the central bank. The central bank does not trade the forex market. They only participate in the forex market by stabilizing the currency of that of the forex market. Okay, I'm going to quickly give you guys an analogy of what happened recently. Yeah, so recently, just before the whole coronavirus thing started, remember oil dropped to negative actually. So let me not even say $1 or $0. Yeah, oil actually did drop to negative. Okay, that is the Brent oil. And when this happened, it was really crazy because you all know that one of the major source of revenue for Nigerians is what? Oil. All right, Nigeria actually depend mostly on oil to generate its revenue. And when that happened, it was really crazy that it had to affect our economy. And as a forex trader, this is another reason why you should go into forex trading and really understand it. As a forex trader, when you notice that there is an oil drop, before any announcement, because we are actually in this part of the world, a lot of people are actually ignorant, and before a news is announced, before a news is casted, what is most likely going to happen is that you would be aware that, okay, this will most likely be the next line of action, and you quickly protect yourself as a forex trader. All right, for example, now when oil dropped, I'm going to tell you what I did. Okay, when oil dropped, I noticed it was over the weekend, and on Monday morning, just before they will announce it, because once they announce it, what do you think is going to happen next? Everything starts getting expensive. Okay, just before they announced it, my dear, I left my house, withdrew some money from my Naira account, then I deposited it in my dollar account. Okay, because for that oil drop, the next line, the next most important thing, the next likable thing that is going to happen is that we're going to have a devaluation of the Naira, which means it's going to go up. Then we are going to have an increase in daily consumables. Those two is going to be a compulsory thing since we had that drop. And I could actually anticipate that because of what? I was a forex trader and I was aware. Okay, so you see why it is essential too. It's not just about trading the forex market, it's about being aware. So the first thing I did that morning, I went to the bank, I withdrew some money from my Naira account, I deposited in my dollar account, and again, out of the money, I went to the market immediately and I bought food stuff and I stocked my house. All right, and by evening, I'm telling you, I did this within the day. By evening, those stuff that I bought in the morning had already increased in price, and the money I withdrew from my Naira account, then I withdrew at 360. Then, and by the grace of God, when I was going to withdraw it back again from my dollar account, I withdrew it at 425. So you see, it's not about this was not even trading. It's just about being aware of the education on what the forex market is really about. Okay, so the CBN, they don't trade the market, they just try to stabilize the market. Okay, so what was expected of the Central Bank of Nigeria then was to pump some money into the forex market, because obviously the Naira was going to lose value. So if they pump money into the forex market, it's going to try to stabilize the naira a little bit. So naira actually hitting about $500 naira per dollar wouldn't have happened if the CBN had played their role. But I heard that Nigeria is broke, which I don't believe anyway, and that is why we were unable to get into that. We were able to CBN was unable to pump money into the forex market. Now let us look at the United States. The United States actually pumped, I think, about $200 million into the forex market. Immediately oil dropped. Okay, and that was why the US dollar kept gaining more strength at that time. So they try to strengthen the dollar with that, and so it doesn't lose its value, and that further affected naira more because the dollar is a unit of measure for most currencies in the world, including naira too. And these are ways that these individuals, this organization or these parties actually participate in the forex market. Okay, so let's now, what is traded in the forex market? Like, we have the currency pairs and all. Now let's quickly look at who is a forex broker and setting up an account. Okay, now who is a forex broker? Who is a forex broker? Okay, for you, this is it. Okay, most people, before you begin to confuse it, we're going to use CCI as an example. Okay, CCI is standing here. Okay, if you think that you registering on CCI and putting your money on CCI platform, okay, to trade the forex market, you are giving your money to CCI, then you don't really understand what is happening. CCI is not even taking any money from you. CCI is only giving you access to the forex market. Okay, like now, if for example we have Dangote group of companies now. Okay, Dangote is, you want to buy Dangote shares, you don't just go to Dangote and say give me shares. Okay, this is Dangote. You don't just jump to Dangote and say give me shares. Okay, you go through an intermediary, somebody in between that knows that is going to give you access to reach Dangote. Okay, that is Dangote group of companies. Okay, so that intermediary is what is referred to as a broker. Okay, that intermediary is what you refer to as a broker. All right, so also the forex market, this is the forex market. You need a broker to access the forex market, and such broker is what? CCI Trading. Okay, that is CCItraders.com. Okay, so once you are registered on the CCItraders.com platform, then you gain access to the forex market. Okay, then that way, when you fund your account with CCI, you're actually funding your forex account to have access for you to trade the forex market. Okay, so a broker is simply an institution or a body that gives you access to the forex market. Okay, so that is why when you want to go into forex trading, you want to look at what forex trading is all about. One of the best brokers to actually go through is CCI Trading, because they have incredible spread, and there is no manipulation on the platform, and that makes it easier for you to trade the forex market. Okay, so if you haven't registered your account yet for you to have access to the forex market, please kindly do that. And if you have done that, start practicing on your demo account and then proceed to. And if you don't have the knowledge on how to practice on your demo account, be rest assured you're going to get the education here on CCI Trading. Okay, so setting up your trading account, you're going to get directions on how to do this on the website, and we are going to give you more education too on how to go about this, because it's going to be more of a live on action too via this webinar as time proceeds. So we have what we refer to as trading times and trading sessions. Okay, so when it comes to trading, you don't just wake up out of the blue and say, okay, I want to go and start trading. No, it doesn't happen that way. You don't just wake up out of the blue and say, I want to go and start trading. It doesn't happen that way. Okay, so what you should do is to study the trading times. Okay, so I'm going to, in Forex trading, we have excuse me, In forex trading, we have 4 trading sessions actually. Okay, I believe everybody on this call has a pen and a paper, and you're jotting 1 or 2 things down since that we'll be talking to. You should also jot this down. In forex trading, we have 4 trading sessions. We have the London session. I'm slowing down so you can write it down. We have the London session. We have the New York session. We have the Tokyo session, and finally we have the Sydney session. Okay, London, New York, Tokyo, and Sydney. All right, so the Sydney and the Tokyo and the Sydney section is popularly referred to as the Asian session. Okay, because this actually falls into the Asian region. Okay, so the Sydney and the Tokyo are popularly referred to as what? The Asian session. Now, when we have these sessions, it definitely means that these sessions are actually going to be opening at a particular point in time. Now, I believe you can see my screen. So go to www.forexmarkethours.com. www.forexmarkethours.com. Okay, so upon getting here, as for those of us as for those of us who actually joined later in this call, kindly go to the chat section, drop your email, your email address, your phone number, and your full name in the chat section together, so that you can get the educational materials and most likely get the recording of this training. Okay, now when you get there, www.forexmarkethours.com, you're going to see all the live sessions here. You can see we have the London, the New York, the Sydney, and the Tokyo session. So it depends on where you are located at the moment. Okay, so if you're in America, New York, you're going to use this time zone. But since we have majority of the people on this call from Nigeria, so what we're going to do is we're going to switch to Africa. Okay, Africa, Lagos. That is GMT +1. All right, so let's quickly look for that together, guys. Africa, Lagos. Yeah, this is it. Africa, Lagos, GMT +1. Then you click on go. Now, doing this, you're going to realize the time just changed. Now, this shows you when each market session opens. Okay, we have the London session opening by 8 o'clock and then closing by 4 o'clock. Okay, that's this green part here. We have the New York session opening by 1 o'clock and then closing by what? 9 o'clock. Okay, that is 10 o'clock open actually, closing by 10 o'clock on the dot. That is what? New York session. Then we have the Sydney session opening by what? 10 o'clock and then closing by 6 o'clock in the morning. Then we have the Tokyo session opening by 12 o'clock and then closing by 9 o'clock in the morning. Yeah, so if you look at this very closely, you're going to realize that we have the London session falling into the New York session between the hours of 1 o'clock and then 4 o'clock. Okay, let's just say 5 o'clock, between the hours of 1 o'clock and then 5 o'clock. Okay, so excuse me. So now at this point, this is what we refer to as the overlap session. Okay, this is what we refer to as what? The overlap session. It is called the London and the New York overlap. Okay, so then we also have the Sydney and the Tokyo overlap. So if you look at the Sydney and the Tokyo, you see that the overlap happens almost throughout the entire session. That is why they just put it together as what? The Asian session. So by the time you go out there and you hear some forex traders saying the Asian session, most often they don't say Sydney session, or neither do they say Tokyo session, they just say what the Asian session. You should know what they are talking about. Okay, now these sessions are actually very crucial to your learning. Okay, these sessions are actually very, very crucial to your learning. Okay, now why am I saying this? Not just your learning, actually, to your trading too, because you don't want to be trading all the sessions. We said the New York session closes by 10 o'clock, 9:10. By 10 o'clock, the Sydney session starts, goes into what? Midnight. As a Nigerian, you want to be sleeping. Okay, so those sessions, you either choose sleep or you choose trade, or you choose what to trade. The London sessions too, you either choose to sleep or you choose to trade. So what you're going to be doing as a forex trader is understand your trading system. After you've been taught, understand your trading system and look at the best session to trade that trading system of yours. And also, we're still going to talk about currency pairs. You look at the currency pairs and you know the session to trade such currency pairs. Okay, like I said, we have the London session, we have the New York session, we have the Asian session. It is not going to make any sense if you are trading a Japanese yen. Okay, if you are trading a Japanese yen during a session when you are supposed to be trading a British pound. Okay, why is it not going to make sense? Simply because there would be no volume in the market as at that particular time that you're trading. That market, the people that are trading that market are asleep. Okay, what really builds up this session is that at that point, most of the banks, most of the financial institutions in that particular region of the world are awake and what? Doing business. So they are awake and doing business. That means the forex market at that point too is also what? Up and running. So when they are asleep and not doing business, what are you doing with the pair? Okay, so these are things that you need to consider when it comes to what? Trading session. And London and New York overlap is popularly referred to as the best trading session, simply because that is when you tend to have more volume in the market to trade. Okay, that's when you have more volume in the market to trade. So let's continue. Now you know what trading times is and trading session. You know how to get there. Also, aside from that, I gave you www.forexmarkethours.com. Also, I would like you guys to also check www. You can also write it down, forexfactory.com. Forex Factory. So on forexfactory.com, what do you see there? Okay. On forexfactory.com, you can see we have nothing here. So let me quickly drop this. So on Monday, September 7th, these are the news available for you to watch out for because in trading we have technicals, we have fundamentals too. Okay. So these are news. Okay, on forexfactory.com, you get all the news that will most likely affect the forex market, and you want to prepare for this news. Okay, the best thing to do when you have an high impact, we have high impact, we have low impact, and we have medium impact. The best thing to do when you have an high impact news is to stay off the market, depending on your trading system actually. Okay, so for you need to be aware of this. Okay, so you want to check on the next news available, go to www.forexfactory.com, and let me quickly show you guys something. Like, there's something we call NFP in forex trading, which is the non-farm payroll, and this comes on the last the first Friday of every month actually. And as at which is Friday yesterday, you can see we had that news. These are all the news here, high impact news. You can see unemployment change, unemployment rate, the average hourly, and then the NFP. Okay, so that happened yesterday, and that was why we had a lot of movement happening up and down yesterday, as at that time, which was I think 1:30 p.m. Yeah, so you want to be aware of that. So go to www.forexfactory.com. Once you get there, come to this top right here. This is where we have the time. Click on it. Then try to set your time to GMT plus 1, just like I have here, because you're most likely not going to have it at GMT plus 1 too. Okay, set it to GMT plus 1 to fit into your Nigerian time. Okay. Now, let's proceed. We're going to look at what was the name? Like when we talk about forms of trading, I believe you guys have the what was the name? The curriculum for this session that we're really trying to walk through. All right. So we have what's the name? We have forms of trading, like we have the technical analysis, the fundamental analysis, and then we have the sentimental analysis. These are the 3 types of analysis that we actually have in Forex trading. Okay, so at the end of the day, it's good for you to be aware of each and every one of them is, and that's where you can try to tell yourself which one you want to fall into. Like myself now, after really understanding what each and every one of them is, I am actually more of a technical trader than any of the other 2. Okay, so those are the 3 types of analysis we have in Forex trading. Now, but not the least, before we call it a day, we are going to look at the currency pairs. Okay, we are going to look at the currency pairs. Now, what are currency pairs? What are currency pairs? You know, earlier I told you guys that I told you guys that currencies are what is being traded in the Forex market. I told you guys that currencies are what is being traded in the Forex market, and in these currencies, you don't just go there. You know, like I said, it has to do with buying and selling. So if I'm doing an international transaction now with my card, and I'm requested to pay, for example, I want to buy an iPhone worth $1,000, and I'm to pay with my card. Obviously, I'm not going to be paying. I'm paying with my Naira card, so I'm not going to be paying dollars here. So the value is actually going to be exchanged to the dollar rate, all right? To the Naira rate actually for the dollar. Yeah. So if I'm paying with my card now and I want to pay that $1,000, it's going to be what? Me paying Naira for dollar. Okay, so now what are we? So if we're looking at it as we're trading Forex, so what are we doing? We're trading what? We are trading 2 currencies, yeah? So that is what is being referred to as what? As a currency pair. So that will be seen as what? The US dollar versus the Nigerian Naira. Okay, so we have such currency pairs like that. We could have the US dollar versus the Japanese yen, the US dollar versus the Swiss franc, the US dollar versus the British pound versus the US dollar, and so on and so forth. Okay, I'm coming. Let's quickly look at some of them here. So these are currency pairs. Yeah. So you could have the US dollar. That now under the currency pairs, we have 7 major currencies. Let us quickly go into that and write them down if you can as quickly as possible. We're rounding up for this session. We have 7 major currencies. We have the US dollar. We have the British pound. We have the Australian dollar. We have the New Zealand dollar. We have the Swiss franc. We have the Japanese yen. And last and not the least, we have last but not the least, we have let's see, I said Japanese, okay, the Canadian dollar. Yeah, so those are the 7 major currencies that we have. 7 or 8, sorry. Then we have the euro. There are 8 major pairs, actually, major currencies, not pairs, major currencies. Okay, now when we are not trying to pair these currencies, okay, there's something we call the major pairs. Okay, we have major currency pairs and then we have cross pairs. Okay, the major currency pairs are all the 7. I said we have 8 major pairs. Eight major currencies, which I have listed out just now. So the major currency pairs are all the 7 other pairs out of the all the 7 other currencies out of the 8 paired with what? The US dollars. That is why I said earlier that US dollar is the unit of measure for most currency pairs across the globe. So when you talk about major pairs, you have pairs like, okay, like we have major currency pairs. We have pairs like what, the US dollar. You can see paired with what, the Japanese yen, the US dollar paired with what, the British pound, the AED Australian dollar paired with what, the US dollar, the US dollar paired with the Swiss franc, the US dollar paired with the Canadian dollar, the New Zealand dollar paired with the US dollar. Those that makes it 7. Okay, so those are the 7. We now call this the 7 major currency pairs. Then we now have the cross pairs, okay, or the minor pairs. They are all other pairs aside from the US dollar paired together. Those are what we refer to as cross pairs or the minor pairs. Then last but not the least, we have what we refer to as what, the exotic pairs. Okay, the exotic pairs are those pairs that are hardly traded in the forex market. Okay, those are like, you could have the US dollar versus the South African rand. They are rarely traded. The US dollar versus the Nigerian naira are rarely traded. The US dollar versus the Danish, what's the name again? Sorry, the US dollar versus the Mexican peso rarely traded. So those are exotic pairs. Okay, so these are the pairs that we have in forex trading. Okay, and last but not the least, we have what we refer to as what, the MetaTrader 4. Everybody should go to Play Store or App Store, download your MetaTrader 4 and your MetaTrader 5, because these are the app and interface that you need to have access to the forex market through your broker. Okay, so thank you very much. My co-colleague in training is going to continue after this and put you through what the MT4 and MT5 is and other aspects of the Forex Foundation course. I really appreciate you all. I remain my humble self, Mr. Yusuf Jamil. I'm going to hand it over now to the moderator. Thank you very much. I appreciate you all. Keep your questions. We'll answer it after the training. Over to you, Sam, the host.
Hello, everyone. Thank you very much, Mr. Yusuf.
Everybody, thank you, sir.
Yes, so I will be introducing our next host, Mr. Sunday Respect. Mr. Sunday Respect is going to be our next speaker. Mr. Sunday Respect, I'm going to read his profile for us. Mr. Sunday Respect is an Institute Forex technical analyst, trader, coach, and mentor, alumni of InnerCycleTrader.com, a believer of price action, institutional order flow, and liquidity delivery. He has wealth of experience, wealth of experimental knowledge of the Forex technical trading. He has also mentored a good number of students through his simple, predictable, practicable yet powerful method of teaching to become clinical and precision traders with a good strike rate. Respect strongly believes that sound technical knowledge does not translate into profitability without a healthy trading psychology and strict risk management. He is a follower and mentee of industry's best trading psychology mentors. Respect believes that trading fortunes is tied to sound technical knowledge, healthy psychology, and risk management. Absence of these 3 factors will lead to misfortunes and pains. So does Mr. Respect believes. Trading is a form of investment, and cultivating the investor's mindset is key to longevity. Ladies and gentlemen, it's time for us to listen to Mr. Sunday Respect. Mr. Sunday Respect will be the one that will be taking us in the next phase of this training. I hope we all are ready to listen to Mr. Sunday Respect to get a word or his experiences in this business. Welcome, Mr. Sunday Respect.
Thank you, Mr. Yusuf.
Welcome.
I was taking notes in your class. The amazing is you get to learn every day. So the number one thing we do here is we trade digital currency. We don't trade physical, we trade virtually. So we use our phones and our laptops in trading. So I know most of you are on your phone right now So you would go to your Play Store, then you type in the app you want to be downloading, which is your MetaTrader 5. Now, why MetaTrader 5? We would be using MetaTrader 5 because this platform is hosted on MetaTrader 5. All right, and MetaTrader 5 has more advanced features and better features than the MetaTrader 4 on the mobile. So you'll be downloading the MetaTrader 5 on your phone. So you type the MT5, all right, MetaTrader 5. So you just type MetaTrader 5. Click on the MetaTrader 5. All right. Because I already have the MetaTrader 5 on my on my phone, so I do not have to install it again. But since you don't have it, if you don't have it on your phone, you just simply need to download it. After you're done downloading, it will open this way. Now, on the MetaTrader 5, all right, you're going to see this. You're going to see this instrument, what you're seeing right now. What you have here now, you can see the AUD USD at the top, the topmost top. That is the currency pair. That is the currency pair. All right, that's what we call currency pairs. What this means is that the AUD is being paired, like Mr. Yusuf said in his session. The AUD is the Australian dollar and is being paired with the Canadian dollar. Now, the AUD on its own is a currency, while the Canadian dollar is a currency too on its own. Two different economies. The AUD economy is the Australian dollar economy is controlled by gold, while the Canadian dollar is controlled by crude oil. Okay, so you're pairing these two currencies means you're bringing two economies together, two different economies. So that being said, because you're pairing two economies together, okay, that gives you the Australian dollar and the Canadian dollar. Same with the major pair, which is the AUD. You can see the AUD USD. All right, the AUD USD is what we call a major pair because it's being paired with the dollar. So any currency unit that is being paired with the dollar is called the major. Any currency pair that has the dollar in it, it's being called the major. Every other currency pair that does not have the dollar in it, that's the US dollar in it, is called the cross pair or the minus. All right. Now, when you have this on your screen, your currency units might not be as much as you wanted. So if you want to add more currency pair to your MetaTrader 4, you click on the plus sign. There's a plus sign at the top of your screen, very close to the biro, the plus sign. So click on the plus sign, right, and click on Forex. Now you would see more options of various different currency pairs. So if you would like to trade each of any of these pairs here, you simply click on them. It will be added to your list. So once you tap on it, the currency pair would not be found on this listing again. What that means is that it disappears from this listing and is added to your currency pairs of choice. So we can have the Euro JPY. This Euro JPY means the Euro versus the Japanese yen. So I want to add the Euro versus Japanese yen because I have interest in trading the Euro versus the Japanese yen. I'm going to add this also. We're going to add this also. All right. So whichever currency pair you have interest in trading, you get to add it to your list. Okay. Now, when you are done adding the currency pairs, you click on the arrow that takes you back. Now, because we also trade other instruments like the commodity pairs and all, you go to the plus sign again, go to where you have commodities, click on commodities. You're going to see various commodities that the platform also offer you opportunity to trade. All right. And we also have the metal and energy spots, and silver. So what that means is that if you have interest in trading gold and silver, you can also add those options to your listing. Now, for gold spots, the symbol is XAUUSD. That is for gold spots. All right, that's for gold spots. So that is how you add your currency pairs to it. Now, we'll be talking about types of execution. As a trader myself, as I am a technical analyst and a technical trader myself, my style of trading, my system of trading allows me to trade what we call the pending orders. All right. So my kind of pending order is the buy limit and the sell limit. What that means is I anticipate where I expect the market price to get to pick my order, and I set my limit and I wait for price to get there. So I click on the AUD card. The first thing you see the currency pair, which is the AUD card. All right, that's the Australian dollar and Canadian dollar. Okay, then you will see the option that says new order. So I click on the new order. All right, you see a new interface. Now, the first thing after the Australian dollar versus Canadian dollar, the next thing you have is what we call market execution. Now, in a market execution type of order, it means that, for instance, you want to buy the Australian dollar against the CAD, like you want to buy the Australian dollar versus CAD. What it means that, okay, for a market order, it means that you want to buy at the current market price. So I take, for example, you have interest in buying a Rolex wristwatch, and you got to the market, your jewelry store, and the jeweler tells you that, okay, this Rolex wristwatch is going to cost one Rolex wristwatch is going to cost to have the $10,000 that you can afford to buy that Rolex wristwatch. For a market execution, it means that you are buying at the current market price. So the moment you hand over $10,000 to the jeweler, and the jeweler hands over the wristwatch to you, what you did at that time is you bought that wristwatch at a market execution, at a market price, an instant execution. So that is a market type, and there are traders who trade instant execution. So what the market will most likely get to, or what the market will most likely reach up to, so they position themselves and then they take their order in the direction of where they expect the market to go to. That type of order is called the market execution or instant execution. All right. Now, on that market execution, if you click on the market execution, you're going to have more options pop up on your screen. You can see the options. We have the buy limit and we have the sell limit. We have the buy stop and we have the sell stop. We have the buy stop limit and we have the sell stop limit. Excuse me. So What type of order where you expect the market price to drop and drop to a particular point? Let me take for instance, you got to your the jewelry store to get a Rolex wristwatch. On getting there, your expectation was that the wristwatch is going to be sold for $8,000. $8,000. All right. And when you got to the store, your budget was $8,000. But the jeweler tells you, oh, this wristwatch is now $12,000. But you know that the reason why that wristwatch is up to that $8,000 is because of high demand at that time or high exchange rate at that time. But you know from experience that there's going to be a drop in price, that the value of that wristwatch is going to drop back. So you say, okay, I cannot buy at $12,000, but I will deposit $8,000 in case the value of the wristwatch from $12,000 to when this price of this wristwatch comes down to $9,000, I get to buy at the $9,000 worth. So that's a buy limit. When we go into the technical charts in our future classes, we're going to get to show you how that is done, how to set a buy limit order. Now, what is a sell limit order? A sell limit order, all right, is a type of execution where, okay, you have, again, the Rolex wristwatch. I love the Rolex wristwatch. That's why I speak about it several times. So you have a Rolex wristwatch that you want to sell. So at the time you bought that Rolex wristwatch, you bought it for $8,000. All right, you bought it for $8,000 and you want to sell that wristwatch so badly. All right, now you went to the market. When you got to the market, they said, oh, the value of the wristwatch is now $8,500 in the current market, and you want to sell your wristwatch, and you are not okay with the value of $8,500. You're not okay with that value of $8,500. So what do? You're waiting, and you say, okay, I'm going to hold on to my wristwatch. When the value of this wristwatch goes up to $10,000 in the market, I will want to sell at $10,000. So you place your limits, you place your order. That's a limit order, that this is the limit at which I want to sell it. I want to sell it at the $10,000 limit, or I want to buy it at the $9,000 limit. Anything below $9,000 might not be too good for your trade. But at the $9,000 or $9,000 or $8,500 limit would be good for your trade. That, okay, I do not expect the value of this asset to go below $9,000. So when this value drops to $9,000, take me into the market. I want to buy at that price. When this value of this asset gets to $10,000, I want to sell from that point. So that is what you get in a buy limit or a sell limit order. Now, a buy stop order is a different type of order, not the same as a buy limit, not the same as the sell limit. Now, what is a buy stop limit? A buy stop order, because buy stop and buy limit are not the same. All right. So what do you do in a buy stop? Buy stop means that, okay, so there are points where you have to go into the trade. All right. At points when you want to go into the trade that are very important for you to note. You do not just open your trade. You do not just open your phone or your laptop and go into the Forex chart and just buy and sell. No. You have to be strategic about everything you do. There are specific points you get into the market. There are specific points you have to exit in the market. So how do you do the buy stop order? All right, in a buy stop order, you have to go in line with what we would call the market structure, which you're going to get to learn in the course of your trainings. All right, you wait at a particular point in the market. For a buy stop, you wait at a particular point in the market. Okay, again, the analogy of the wristwatch. The analogy of the wristwatch. All right, I was supposed to buy a particular asset class at a particular benchmark. Let's say I'm supposed to buy that wristwatch at $8,000 or $9,000, let's say. Then I missed the opportunity of buying it at $9,000, but I can afford to come into the market at 9,500. So for a buy stop limit, you go above the current market price to set your order. That I expect that the value of this asset will go beyond 9,500. So therefore, when price rises up to 9,500, I want price to pick my order, or I want the market to pick my order. And as the value of that asset class keeps increasing, all right, I also get to profit from the increase. The increase that started at the price of 9,500. So any profit above 9,500 means that I have made money in the Forex market. So again, when we go into the practical aspect, you're going to get to see it. All right. So I believe that we're going to have a class during the weekday where the market is open. So you get to see how these orders are placed. The market order, the buy limits, the sell limits, the buy stops, and the sell stop. Now, what is a sell stop? The sell stop is basically the opposite of the buy stop. Oh, the value of this particular asset class is decreasing. There's a current devaluation that is going on in this asset class, and I want to be a part of that devaluation. So what do? I go into the market at a point, set my order, wait at that point for the market to drop in value and pick me. All right, so that is what we call the sell stop. All right, later in our classes we're going to explain what the buy stop limits and the sell stop limits are. All right, so now we're going to be practicing. I'm going to be showing you how to place a trade. So I'm going to show you how to place a trade with the buy limits. So I click on the buy limit option. I have a new interface. You can see buy limits. Below buy limits, you see numbers, figures, minus 0.1, minus 0.01, then a bold number. The minus 0.1 is in blue, the minus 0.01 is in blue, and the 0.1 is in black bold figures. All right, now those values are what we call lot sizes. Lot sizes. Now, what is lot sizes? Lot sizes is basically a representation of the units at which you want to buy. So you go to buy stuff and they'll say, okay, for instance, you want to buy eggs. They'll say, okay, do you want to buy a dozen of egg? If, for instance, you want to buy a dozen of egg, the conversion of such in the Forex market, if you want to buy a particular unit, oh, I want to buy a whole figure that you want to buy from the Forex market, or you want to sell in the Forex market. All right. So those units of purchase in the Forex market is measured by lot sizes. The same way you measure the distance by kilometers or meters. The same way you measure time by minutes, seconds, and hours. The same way you measure quantity by kilogram and the rest. All right. You measure the Forex unit that you want to buy, the unit of a particular currency that you want to purchase in the Forex market by what we call lot sizes. And your lot sizes is determined by the size of your capital. All right. Number one, the size of your capital is what determines your lot size and the percentage you are willing to risk. Now, this particular, when you don't fully understand what we call risk management, money management in Forex, you will shoot yourself on the foot. You would hurt yourself. So your lot size is very important. But if you have a good account size, 500, 300 and above, there is a unit or a system we use in calculating the lot size, which you're going to learn how to use. That site is called myfxbook.com, position size calculator. It tells you the accurate unit of accurate lot size per unit that you're supposed to trade with according to your risk percentage and your equity, that is your capital. All right. So if you want to increase your lot size according to your account size, or you have a good account size and you key in the volumes or the data you want to be working with on the MyFXbook position size calculator, the site is going to give you the accurate lot size to use on that trade. So when that site gives you the accurate lot size to use on that trade, you simply come to the options here. So if you want to increase the lot size to meet with what the system is telling you to trade with, you simply need to do two things. One, you click hold on the number. All right, it will highlight. You can see the highlight, the number that is highlighted on my screen. So for instance, the system tells me to trade with a 0.25. All I just need to do is type 0.25. So the figure changes to 0.25. All right, that's one way of doing it. Another way of doing it is, if I want to reduce this 0.25 to a lesser number, I simply have to click on the figure on my left. The figure on your left will show minus 0.1. So if I tap on it, it reduces the number to 15. If I tap on it again, it reduces the number to 0.05. If I tap on it again, it reduces the number to 0.01. However, if I don't want to do it the first way we did it, I want to do it slowly or incrementally, you come to the side where you have the plus 0.01 or the plus 0.1, and you tap. The numbers will keep increasing. All right, as you keep clicking on that number, it will keep increasing till it gets to the actual lot size that you'll be trading with, or the actual lot size that your account size can carry, or the actual lot size as given to you by the position size calculator. All right. Okay. Now the next thing we have is price. This price here is a representation of the exact point at which you want to get into the market, the exact market price at which you want to get into the market. And this exact market price can be given to you either through a signal from the platform, or when you have gone through the training and you understand more about technical analysis, you would now have access, or you have the knowledge of trading. Then you can be able to say, okay, this reason is one or two reasons. These are the reasons why I want to take this trade at this exact point. That exact point will come in terms of values, in terms of numbers. So what would the number be? Okay, I want to get into the market at, into the market at 0.95 180. All right, 0.95 180. All right, that is where I want to get into the market. Yes, we're going to do an interface of the MetaTrader 5 on the laptop. I'm going to take you through the installation of the MetaTrader 5 on the laptop. The MetaTrader 5 on the laptop will not be the same as the MetaTrader 5 on the mobile phone. That is the value we have there, the 0.95180, will be a value where I would like to get into the market based on my technical analysis or based off of the signal that I'm getting from a master trader or an educator on the platform that decide to give out a trade idea of what is looking at in the market. All right, so you can see on the left side, you see SL. That SL is a short word for stop loss. Now, what is a stop loss? What is stop loss? Now, stop loss is a trading mechanism that is being introduced in electronic trading to stop your trade when you are in a loss. It automatically stops your trade when you are in a loss. So, why stop loss? Before the introduction of stop losses, people used to stop their trade manually. But the system, all right, when the system Forex trading became more of a virtual thing, more of electronic thing, with the introduction of internet and the rest, all right, a system was introduced to stop you out automatically. So either you are on your computer or not, you're driving or you are sleeping. Once you place a trade and you set a stop loss, if that trade goes against your position, the system would automatically stop you out when the market gets to the point where you set that you would like to be stopped out. Now, let me explain what the stop loss means in a very layman term. Now, you have a car, all right, and your car, you gave your car to a driver or an Uber driver on hire purchase, or you gave let me use hire purchase. You gave it to an Uber driver for a hire purchase, all right? And you have an agreement with your Uber driver that, okay, you're going to be paying me X amount of money every week. However, based on contract, if you default 2 times or more than twice the payment, you are going to lose the car. So whatever amount of money you already paid to me will go as a loss. That's a contract. That's a benchmark that will stop the contract. So how does it relate to Forex? When you go into the marketplace, for instance, you want to buy a particular asset class at maybe, let's say you want to buy a Rolex wristwatch at $9,500. All right. Now, you set a benchmark that if this value goes below $9,000, stop me out. I do not want to lose my money beyond $9,000. So I'm willing and ready to risk 500 of my money in that trade. So once you lose up to 500 of your money in that trade, the system stops you out and preserves your 9,000. But if you trade without a stop loss, all right, and eventually the market goes in the opposite direction of your order, let's say you are expecting the market to buy at a particular point and the market gets to that point and continues selling without your stop loss, if the market continues to sell further below where you entered into the market, your money would keep reducing, you will keep losing money until your entire money disappears from your MT4 or from your trading account. The market takes all your money. But when you trade with a stop loss, you only expose your account to a certain amount of risk. You expose your money to a certain amount of risk. that, okay, I have $100 that I'm trading with, for instance, and I want to take a trade. I am willing to risk $5 out of my $100. So if I take a trade and the market is going against my position, I want this market or this system to stop me out when I am negative $5. And I want the system to stop me out so that when the system stop me out, I can preserve $95 of my money. I don't get to lose the entire $100 in one trade. I am willing to risk $5 only. Once the market goes against me, I want to lose only $5. Let the system preserve my $95 so that I can have money to go back into another trade. Again, how do you arrive at the values for your stop loss? Your values for your stop loss is going to be arrived from the place of technical analysis. You don't just go into the market and say, I'm buying here, I put my stop loss here. No, you arrive at the place of you get your stop loss from technical analysis. All right. So your technical analysis will most likely give you your stop loss value. Now, for a buy position, your stop loss is usually below the price at which you're buying at. So let's say I want to buy at 0.95180. If I have to place my stop loss in this scenario, all right, my stop loss will most likely be below that price, which might be 0.95, maybe. All right, might have a 10 pip stop loss, 0.9580. All right, that will most likely be my stop loss. All right, so what is the TP? On the right side of your chart, you can see the value we call TP. It's the short form of the word take profit. What is a take profit? What is take profit in the Forex market? All right. What is the take profit in the Forex market? The take profit, or in the digital trading, the take profit is a mechanism that allows you to set a profit margin. So, for instance, you set your profit margin through technical analysis that, okay, based on technical understanding, my technical understanding of the market, based on the indicators that I'm seeing on the chart, I think that this particular asset class would move from 0.95180 to maybe 0.95 300. All right, so that is you setting a benchmark that, okay, I am buying this thing at 9,500, for instance, the Rolex wristwatch, and I will hold on to my Rolex wristwatch until the value of this Rolex wristwatch goes up in the market to $13,000. I bought it at 9,500. Watch increased up to $13,000. Now, I believe that at $13,000, I should be okay with the profit. So when the value of my wristwatch gets to $13,000, all right, I take my profit. What do I mean by take profit? The value between 9,000, the difference between 9,000 and 9,500 and $13,000 is the profit I made from the purchase of that wristwatch. So that's what we call take profit in Forex. So the value, the difference between 0.95180 and 0.95300, or whatever value the chart allows you, 350, all right, would be my what? My take profit margin. So when you have these things placed, if the market was open, below it you will see an option that shows place. So what that means, if the market was active, if today was an active market day, and my analysis are correct, I would simply do what? Place the order, and I will go about my business. The moment the market comes to the point where I want to get into the market, it picks my order. If my analysis is right, it will go in my way and I will make profit. If my analysis is wrong, it will stop me out at my stop loss. A portion of my money will be taken off as the cost of that trade, or a portion of, or a certain amount of money will be added into my added to my capital as my reward from that trade. So you lose when the market goes against you and stop you out. You gain when the market goes your way and gets to your take profit level. All right. Now, that is what we call, that's how you place a buy limit on your phone. Okay. If the option was for a sell limit, if the option is for a sell limit, you follow through the same process. The figures will be given to you, or you arrive at the same figure. Sell limit, you also have to have an entry price. You also have to have a stop loss. You also have to have a take profit level. Then for a buy stop, the same thing happens in a buy stop. A buy stop, you will have an entry price, a stop loss, all right, and a take profit level. Same thing with a sell stop, all right. But for a market execution, the market execution is different. A market execution does not give you the entry price. The value at which the market is at currently, at that present time where you want to buy or sell, is what will become your entry price. The only thing you get to have, or in a market execution, is you get to set your stop loss and your take profit. You will not have an entry price for a market execution. Now you will see two options below the screen, before the number area: sell by market or buy by market. Now, if the options available to you was a buy now or buy by market, you simply click on buy by market. What it means is you're buying at the market price. Then you put the stop loss and the take profit. If the order was a sell by market, you simply put your sell, your stop loss and your take profit. Then you sell at the market price. All right. Okay. So now we are going to be talking about expiration. Okay. Now I'm going to explain the expiration for you. So the expiration is basically you setting a time window that, okay, I'm expecting the market to get to this point within an hour or within 2 days. So you set the expiration date. You specify the date and the time that you expect the market to get there. But this is not always very important though. It's not always very important. I don't use it because I believe in my analysis. Two things will happen. If the market conditions remain the same, my order will play out. If it doesn't remain the same, then I either delete it. Most likely I'm going to take off my order. All right. So this is not really important, but you can also set it. If there's an order for you to set an expiration, then fine. But if not, don't bother yourself with that. Okay. Now we've explained the types of execution: the buy limit, the sell limit, the buy stop, the sell stop, the market execution. Now, the next thing we're going to be talking about this, the what we call PEEP. Now, like I said, you use lot size to measure the units that you're buying. Lot size gives you the units that you're buying. All right. Now, what is a PEEP? PEEP, P-I-P. P-I-P, PEEP. what is PIP? All right, you're going to have you're going to get the lesson notes sent to your email. So that's why it's very important that you drop your email and your phone number, the details that you've been asked to drop. All right, you have to drop those details so that you get to receive the lesson notes. You're going to get a lesson note after this call. So what is PIP? The lesson notes will explain further some of the things that we've talked about. So what is PIP? All right, PIP, PIP. All right, so because we are forex traders, we measure our profits in pips, and we measure our losses also in pips. All right, what is pips? PIP is basically price interest point. Price interest point. Price, so it's an abbreviation of the word price interest points. So you measure the forex market by pips. So the same way you measure distance by meters or kilometers, you measure your profit or your losses by pips. All right, so when we say, oh, the market has moved 50 pips, it means that the market has moved 50 points. The interest of the market has increased in value by 50 points in your favor. Oh, when we say put your stop loss at 10 pips, what that means is that you are expecting your projection, your analysis says, if the market goes against me by 10 points, stop me out of the trade. If the market goes against me by 10 points, stop me out of the trade. Or if the market goes against me by 20 points, stop me out of the trade. So you measure your profits by PIP. You measure your stop losses also by PIP. All right. Now, how is the PIP calculated? Very simple. Now, you can see on my screen the price, which happened to be my entry price. Let's say I am selling, or I'm in a buy limit. My entry price is 0.95180. Then I have a stop loss at 0.95080. Now, how do I know the amount of pips I am risking on this trade? It is simple. You simply just have to do what? Minus these two numbers by themselves. What do I mean? Can somebody help me with that calculation very quickly? 0.95180 minus 0. All right, I'm coming. Minus 0.95080. Now, that will give you 100. The answer to that question is 10 pips. Why 10 pips? You get 10. Why 10? Now, in a currency unit like this, I'm coming, I'm going to explain. Yeah, the answer is 100. I'm coming. Just listen and go through with me. In a currency unit like this, where you have 5 digits after the decimal point, 5 digits after the decimal point. From that decimal point, you have 95080. The last digit, the 5th digit, is what we call pipette. So you ignore that. That is not. You just ignore it. You ignore it completely because it doesn't count in the scheme of things. Pipette. All right. You ignore that last digit. So if you ignore that last digit, what you're going to get is 10. So the difference between
my entry price and my stop loss is 10 pips, because I am meant to ignore the last digit. Again, when you get your lecture notes, which is going to be sent to your email, you're going to understand what we're talking about right here. So you always ignore the last digit when you have 5 decimal, when you have 5 digits after the decimal point. Any currency unit that you have 5 digits after the decimal point, you have to only work with the first 4 digits. Ignore the 5th digit. Ignore the 5th digit. Now, with this explanation now, can you do the same calculation here? So for a take profit, so in this currency unit now where you have, at this point now we have our take profit. So if you do your calculation, you minus your entry price from your take profit, the answer you get will be your likely profit, the profit that you make from that trade in terms of pips. So when you hear I took a trade and I made 50 pips, the distance between the entry points and the take profit is what is being calculated in terms of your profit. The distance between the entry price and the take profit is your pips reward. Your distance between your entry price and your stop loss is what you stand to lose if the trade goes against you in terms of pips. Okay, so let me pick another currency pair that does not look exactly as what we just talked about. So you can see here a new currency pair has been picked, which happened to be what? The Australian dollar versus the Japanese yen. I have an entry price of 7, all right, 0.395. Okay. Now, of course, I would have a stop loss of maybe 7 point 2. I have a take profit of 7 and 620. All right. Now you see this currency unit has only 3 digits after the decimal points on this particular currency unit. Now, where is the pip? You're focused on this currency unit that has 2 decimal points, 2 figures or 2 digits after the decimal point. You want to work with the first 2 numbers. The last one, which is the 5, you ignore it. That is the pipet. So your pips calculation is done between the 2. The 39, the 5, you ignore it. The 5 is the pipet. The 5 is the pipet. So you ignore that 5. So if you have to do your calculation, you have to do 77.395 minus 77.295. So the answer you get is going to be 10. You most likely get 100. Again, you know what to do. You ignore this last. So this 2 is your pip. The last one is your pipet. The currency pairs that will most likely be in this format is always the JPY pairs. The JPY pairs, any currency unit that has the Japanese yen, this is how the pip would look like. Every Japanese yen, that's the JPY pairs. The currency unit will always have, you always have a double figure, 7785 points figure after the decimal point. So if Mr. A is trading with a 0.01 and is having 30 pips profit, a 0.01 profit for a 0.01 profit for on a 30 pips trade for a 0.01 position, all right, you're trading with 0.01, your 30 pips on 0.01, all right, would be $3, maybe $2.85 or thereabout. Okay. Now, your profits on 0.01 is not going to be 0.05 or 0.010. Sorry, 0.10. So you're trading with a 0.01 while I'm trading with a 0.10. My 30 pips might be around $30 or $29 point a few cents, while your own 30 pips would be in cents. So it depends on the volume at which you're trading, and your volume is determined by your account size. So that is why I love the Forex market. What you bring into the market and your knowledge size determines how much you earn. Now, your TP when you're buying would go in positive. That is, your TP for a buy will be on the increase, while your stop loss for a buy will be on a decrease. All right. So let me to buy. What that means is that I'm expecting the value of price for a buy limit. The market price had already gone up. Okay. And because of some indicators, I believe that the market price will come back down. So I'm going to set my buy limits here, that when the market price drops into this point, it should pick my buy limits, and from this point it should go back up, increase in value. All right, this is my buy limit, that when price is dropping, it should drop to this point where I get to enter into the market, and the market will go up in my direction for a buy. So in this case, my take profit will be above here, because I expect to get to this area where I circled. That is where above the market price, that's where I want to take my profit for a buy. But my stop loss is going to be beneath where I bought from. So in this case, for a buy, my stop loss is going to be beneath, which means that my stop loss is going to be in negative. Meaning that if price goes negative, it will stop me out on minus on my account. All right, that means that where I expected to buy, price has gone beyond that point. All right, so stop me out. I'll look for another opportunity to either buy or do what the market is asking me to do. You get to understand that through technical analysis. All right, now for a sell, the market was already going down. Okay. And maybe for a sell limit, now this is a sell limit. I expect, based on some technical analysis and some indicators that I've seen in the market, I believe that the market value was going to come up some more up to this point. So what am I going to do? I set my sell at this point where I expect for it to start selling from again. Okay, that is the point where I have my entry price, and my stop loss will be above here. So what I'm doing is this, when the market increases in value up to this point, I want the market to pick me in that trade and then continue going down as it was going. So this would mean a devaluation, but this devaluation is profit also for me, because we as digital traders or virtual traders, we make profit from both buys and sells. So the volume is the market, the currency is losing its value, or the market price is going down, we make profit. The market price is going up, we make profit also. So either ways, we make profit from buys and sells. So of course, when you're selling, your take profit will be in minus. That minus means money for you also. While your take profit for a buy will be on the increase, it also means money for you also. Okay. So we make money from both sides of the market. All you just need to understand as a technical analyst is which direction is the market poised to go to, or which direction of the market are we expecting price to move to. Is it going to go up? Is it going to go down? So you position yourself and choose the type of order you want to be trading within that time window. So let me talk about take partials very quickly. Then I talk on break even. You get a lot of these things more further explained in your study notes. You're going to get it, right? That will promise you. So, what is take profit? What is take partials? Take partials is, for instance, I went to Mr. Valentine Nwoke to borrow money. Okay, Mr. Valentine Nwoke, please give me 10,000 naira. And he kindly gives me 10,000 naira. I'm going to give you back your 10,000 naira so time. So, 3 days after, Mr. Valentine is expecting his $10,000, 10,000 naira from me. So I go to Mr. Valentine and said, I don't have all the 10,000. No, I bring 7,000. 7,000 is available. Now, what is due, Mr. Valentine, is 10,000, not 7,000. But will it be wise for Mr. Valentine to reject the 7,000 and say, go back until my money is complete, you bring it? Mr. Valentine, would that be a wise decision? I don't think it will be a wise decision. Once you know that the person is going to pay you complete money, you would gladly take the 7,000 from him. That is you taking partials of what is due to you. You're taking partials of what you are expecting from the market. Yes. So what do I mean? How does that concern the Forex market? When you're in technical trading, you analyze your charts, expect the market to move by 50 points in your favor. Okay? Now the market has moved by 30 points. It has not gotten to 50 points yet. Because we do not control the market, we do not know what the market will do exactly, because there are times when the market is expected to go 50 points, but the market goes 35 points and reverses to trade in the opposite direction of your expectation. So we say it is wise that the market goes in your sense for you to take partials of that profit. The profit that you made between where you entered into the market and where the market is currently at, before getting to where your TP is or where you are expected to take profit. So it makes sense for you to take partials of your profit. By taking partials of your profit, you've paid yourself some part of your expected profits, and then you allow the trade to run to get to your final level. Again, I would like to show practical example. So in our next class will most likely be in the market during the trading day, so you can get to it's done and understand fully, because many people take signals but they end up not making money from the signals because they do not know how to manage a trade. Now, what is break even? Now, break even is simple. I would annotate again on my screen. So break even means that, okay, let me use the concept of the sell limit again. So this is where I took my trade from at the sell limit. Okay, above it is my stop loss. Now the market has moved in my favor. I'm expecting the market to move in my favor. Market to move in my favor by 50 points. Now the market has moved in my favor by 35 points. But I don't want to take partials. There are some people that says I don't want to take partials, but I would like to move my stop loss to break even. So what do you do in that situation? The point where you enter the market is here. The point where you have your stop loss is above the market where you enter the market. So how do you break even? How do you break even? Again, this thing is better shown in a live example. All right. So we would communicate to you on the next class, so you get to see a live example and take partials. what I do, or what you do in breaking even, means that you move your stop loss. Break even is an act of moving your stop loss from this point to your entry point. Now, how does this benefit you? This point where you enter the trade is your entry price, where you have your stop loss. All right, from your entry price to your stop loss, this price range, the gap between that level, the pips difference between your entry price and your stop loss is what will be taken out of your money in terms of value, dollar value, if the trade goes against you. So when you move your stop loss to break even, it means that trade, you're no longer risking your money. So if the market should at any point in time reverse and comes back to hit you out at the entry point, you are not going to lose any part of your money, and you're not going to make any money from the market. That is why it's called break even. You did not lose, you did not make money. However, I always advise traders to take partials and break even. So you do two things together. You take partials and you break even, because your number one duty as a trader is to protect your capital. Protection of capital is your number one duty as a trader. You protect your capital. Or as an investor, what are the mechanisms that will ensure that my capital is protected? That is why you trade with stop loss. So you don't trade with stop loss, you are exposing yourself to too much of risk that can take your entire capital away from you. The difference between a trader and a gambler is a trader has stop loss and a trader follows risk management. A gambler does not have stop loss. So when you come into trading and you refuse to risk management and stop losses, you have successfully made yourself a gambler, because a trader's mentality thinks in terms of percentage. How many percent of my account am I going to be making out from a trade? How many percent of my account am I going to be risking on a trade? Now, if I risk 1%, how much percentage am I going to be making? Oh, I'm risking 1% to make back 5%. I'm risking 1% to make back 10%. And one of the things I do, and I believe Mr. Jamil do also, Mr. Yusuf do also, is we focus on trades that give us high risk to reward. Meaning that when you get to learn and understand how to trade, you get to trade with high risk to reward, where one trade can give you back 10% of your account, where one trade can give you back 7% of your account. After all, how much will your bank pay you if you make a deposit of $100 and leave it there for 30 days? I'm not sure your bank would give you 7% of your $100 back as interest after 30 days of deposit. There is no bank that will do that for you. But when you understand how to trade and you follow the rules of trading, you stand a chance of probably making back either 5%, 10%, even sometimes 15%, sometimes 20% of your account from either one trade or two trades. So if your bank will not give you 200% of your profit or return on your investment within 30 days, you shouldn't have that mentality of trying to make 200% of your account from one trade in a day or in 2 hours. That is where traders tend to get greedy and abuse risk to reward or abuse risk management. And the number one factors that fuel the Forex trading market, the technical market, is fear and greed. Fear of losing money and the greed to make more money is what kills many traders. And you see lots of people talk about Forex but are not really profitable in the Forex market. So for me, if I'm able to do 10% of my capital in a week, I'm good. That is a benchmark, 10%. Do I always make 10%? Not always. But there are some times where I make more than 10% in a week. So I trade less. So I can have time to do other things that I'm involved in. Have time to play, have time to go to the gym, have time to do so many things, many other investments that I manage. You have time for those things. The number one goal in trading is financial freedom and security, then your freedom of time. Because as a trader, I can afford to go to anywhere I want to go to and still make money with my phone, computer, and internet. That's all I need to make money. All right. So that being said, we are going to be stopping here for now. Study notes would give you more insight on some other things that we did not talk about on the call. The reason being that some things are better taught practical than just theory. All right. So the theoretical part of our lessons you will get in your lesson notes. However, if you have questions from Mr. Yusuf's session and my sessions, please, we would like to take the next 23 minutes to answer questions. Mr. Yusuf, I believe, is on the call. So if you have questions, as regards what we've talked about, please feel free to ask. Let's use the next 23 minutes that we have left to answer your questions before we call it a day in our session for this day. Any question? Mr. Chidoze, if you can type in just a quick question. In take partials, will the trade still be running even after taking partials? Yes, your trade will still be running even after taking partials. Please, how do you break even again? Well, like I said, break even will be done practically. It's not something we just do theoretically. You like to see it practically done. Okay, let me show you what I mean by break even. So let's say I had a buy limit, okay, 95180. Okay, why are you not moving? 195,180. Okay, and when I was taking the trade, my stop loss was at 0.95080. Now I'm already in profit. My trade is already in profit. If I want to break even on this trade, all right, like I said, it's better done. It's better done on a live call, so you get to see it practically. All I simply need to do is go to that trade that is running, click hold on that trade. The option will pop up. I cannot really explain in terms, but what I mean by that is simply type in your entry price, your initial entry price before taking the trade. The initial entry price before the trade went into profit. All right, that your initial entry price before the trade went into profit will become your new stop loss price. So this is 0.95180 was my initial entry price before the trade went into profit. Now I'm in profit. I want to break even. So I will click on the trade. I would like to show live example, but the market is closed. And I don't have my phone where I trade crypto on right now. I would have shown you on a crypto chart. This will pop up. You see modify. So I click on the option to modify the trade. When you click on the option to modify the trade, the interface will show the same way it's showing right now, but you will not have price. You will only have stop loss and take profit. So all you just simply need to do is you would see where the entry price is. The entry price of that trade will be written at the top of your screen. You will see it and you type the entry price that you had before that trade went into profit. you type it into where you have your stop loss. So I want to break even. I'll just simply do what? Type in 95180, and the option will show modify. So I'll simply do what? Click on modify. What that means is that I have broken even. I have moved my stop loss to entry price. So on that trade, I am not going to lose that trade if I am not on my system and the market retraces back to where I entered the market from. It will only stop me out on break even, no loss. Many times my trade stops me out on break even. Only a few times where I get stopped out on stop loss. I get stopped out on stop loss when I am not right, but I get stopped out on break even many times, because I would have taken partials on a trade and go about my business. Then all of a sudden I come back, check the trade. Maybe that trade did not want to go in my direction. It comes back and stop me out on break even. So I would rather prefer a break even on my trade than a stop loss. But again, stop loss is something that you cannot completely avoid from the Forex market. You cannot completely avoid taking stop loss in the Forex market. You will definitely take losses. But the good thing about Forex losses is our losses in Forex is controlled, calculated losses. Except you broke a rule, that's where you take a loss that will hurt you. But when you follow the rules of trading, your losses is going to be calculated. It's going to be expected. You know what to lose before the loss even appear or before the loss even occur. All right. So I want to believe that you've gotten a lot of value from my boss, Mr. Jamil, and myself. So if you got value from the two calls, type in 5 in the chat box. If you got value from the two sessions, type in 5 in the chat box. So thank you all, and I look forward to having you guys again. Wonderful audience, amazing people. I had so much fun with you guys. So thank you, my host, Mr. Yusuf, for having me today. I hand it over to the host now.
All right. Thank you, Mr. Sunday. I hope we all enjoyed this section. Next week, we will be bringing you another interesting episode. Another interesting educational videos, another interesting mentor that will be giving you guys an insight into this Forex business. It's quite interesting that the Nigerian economy is not helping matters anymore. So if you are privileged to have this first-hand information on how to leverage on the financial market, I assure you that you are at the right place, because this knowledge is not common. It's not everyone that have this knowledge. There was a review by the FX Daily. We have a total of $1.24 million daily traded market in Nigeria alone. In Nigeria alone, just as yesterday close of the day, FX Daily made a review of $1.25 million that Nigerians trade every day in the market. Are you among these people spending this $1.25 million? What are you waiting for? This is the right time. This is the right platform. I assure you that you have not made any mistake joining CCI Traders team. We have wonderful and fantastic mentors, coaches, and traders. Mr. Respect Sunday, thank you very much for this call. Mr. Jamil Yusuf, thank you, and thank you to everyone that have attended this call. It's quite interesting that we have you all on this call. We are ever grateful to you guys, and we say a big thank you and a big thank you for attending this class.